Well, in case you missed it, the Reserve Bank has decided to keep rates unchanged at 8.25%. That is the repo rate, and the prime rate then remains at 11.75%. What impact does this have on the consumer and the wider economy? These are the issues that we're discussing with Mandisa Zavala, Acting Chief Economist at Alexander Forbes, as well as Mamello Matikinca-Ngwenya. She's from FNB. She's the Chief Economist there. Mamello, I just wanted to continue our discussion around the consumer. You do a report on the consumer and how they're handling things, you know, in terms of budgeting for higher end items and so on and so forth, their expectations for the future. What do these barrage of interest rates that we've experienced, even though we didn't get a hike today, what sort of impact is this having on the consumer from your angle?
So I think, although we haven't seen an increase today, I think the consumer is still facing, I think, a considerable amount of pressure due to the high cost of living. The governor spoke a little bit about real wage growth, which has been declining. And of course, this weighs on the consumer's purchasing power. And I think from a survey point of view, when we survey consumer confidence, we can see that sentiment generally remains quite weak. Yes, we did see a little bit of an improvement in the last survey round. But the point really for us is that that index still remains in negative territory. And it's quite clear from the sub-indices within the survey that consumers are in no position to be purchasing big ticket items. And I think some of this also came through in the second quarter GDP numbers, where we saw on a quarter-on-quarter basis that spending activity softened quite a bit. So while, a no hike provides a little bit of relief, I think, the cost of servicing debt is nonetheless still quite high. We unfortunately didn't hear the answer from Deputy Governor Fundi around, how they're viewing NPLs and impairments and so on. And we've seen through various banks that have reported results over the past couple of months that, impairments are increasing. So in essence, consumers are struggling to keep up with the repayment of outstanding debt. So while, yes, this is welcomed in the sense that, rates didn't move higher, I think the strain that the consumer is facing, we're likely to see that persist into 2024.
So Mandisa, just looking closely at the inflation trajectory, obviously the governor spoke to that, but a couple of things that are a bit concerning is the issue of anticipated higher oil prices. I mean, I was reading the other day that there's an expectation that we may see crude oil prices shoot through $100 a barrel, which is massive. And then, of course, there's our generally weak exchange rate, which the governor also spoke to, that we seem to be at the whim of markets. Suddenly the rand suddenly falls quite dramatically, which has inflationary impacts. The combination of those two and other factors could be quite serious. How worried are you about the inflation trajectory, and for how long do you think that's going to be sort of dodgy, before we can see some semblance of, sustainability?
It's such a good question. On the one hand, he sort of touched on the fact that perhaps in the next two inflation runs, we could actually see an increase in inflation. So I think that was something that was interesting, because in essence, it seems as though that is something that they are looking at considerably. But one of the things that he spoke about is it going to be structurally important? So in other words, is this something that's staying or is it temporary? So his wording was, we have to look beyond some of these temporary pushes. And even though I do think there's a huge concern around the oil price and what it could potentially do locally, like you said, we don't necessarily have a lot of levers to pull. It's almost like we're taking the data in, and that's essentially why they say they also are data dependent. I think we have to be concerned when he pointed to the fact that China as an economy is concerning for them because it's experiencing a bit of a slowdown. That does tie in with the global commodity cycle and essentially what we are also experiencing. So a slowdown in China is not something that's great for us, because that demand could have at least been able to sort of absorb some of the issues that we're seeing. And so I think it is multifaceted, and it is something that you can't not be concerned about. And because they also are afraid to sort of commit to the fact that they are done for the year, means that if there is a shock and they feel that it will influence the inflation rate for the rest of the year, they will potentially come out and say, we need to give one more hike. And I think we can't take that out of the bag, even though real rates are as tight as they are right now.
Mandisa, thank you for that. So after a break, we're going to be discussing the issue around, what the wage inflation trajectory looks like, as well as our imports and exports. The Reserve Bank governor talking about our current account deficit widening. What does that mean and why is it important? We're going to be speaking with our analysts on that after a short break. And we continue our discussion on the MP's decision to keep rates unchanged. I'm joined in studio by Mandisa Zavala, Acting Chief Economist at Alexander Forbes, and Mamello Matikinca-Ngwenya. She's the FNB Chief Economist. Thank you very much, ladies, for continuing with this chat. Mamello, let's talk a little bit about wage inflation. Interesting that the governor says that he expects wage inflation to slow down this year and next year, but should or could tick up in 2025. Is that a factor of the fact that businesses are struggling with all the myriad of challenges that they have, cost drivers as well, that they're unable to simply give people increases? Or, or is it from the other side? Are people just sort of settling and saying, well, we're not going to push for increases?
It's quite interesting. So I think if we look at, the latest data that has been released, compensation of employees increased by 3.8% in the first quarter. This is lower than, where inflation was during the quarter. I think, it averaged around 7%, give or take. So I think, we've seen, when you look at the sectorial breakdown, that real wage growth remains quite depressed. And secondly, if we look at employment intentions by sector, we've also seen that those are starting to drift quite lower. And salary growth expectations as surveyed by the BER also shows that expectations are drifting somewhat lower. So it could be a function of, corporate earnings are under a significant amount of pressure. And because of that, that's, feeding into wage expectations. And of course, inflation expectations, while still elevated, are also pushing slightly lower. So those are some of the factors that could have contributed to his statement around compensation coming in somewhat lower, or his expectation there.
So Mandisa, the Reserve Bank governor spoke about the possibility of the current account deficit widening quite substantially compared to this year going into 2024. He was talking about 5.8% of GDP, something like that. I mean, tell us a little bit, or give us a little bit of flavor about why the current account deficit is important. I understand that it's rand negative, and why should, Joe Blog or Jabulani on the street care about it?
So a widening current account is inflationary, like you mentioned, or rather it's rand negative, which means that it weakens the rand, and then it becomes inflationary, because a weak rand becomes inflationary. And if we do have a deficit that is wider, in other words, we are potentially not bringing in as much as we were from a revenue perspective, that does make us vulnerable to the global environment. Now, we are already in a global environment that is now a little bit more stringent. Things are tight. He spoke about the fact that financial conditions globally are tight, touching again on the China issue, but also from a developed market perspective. And so that slowdown in growth, which is what the IMF expects, that we're probably going to be seeing a trickle down in growth from a global perspective, does make us vulnerable as an economy. So when you have a bit of when you have some buffer, so to call it, that does help you, which means your currency is not so willy-nilly. And so Jabu on the street would need to be concerned about it, because then at the end of the day, it becomes something that features into the inflation basket, which we then bear the brunt of that as consumers through rate hike increases.
So here at SABC, we've been telling the story about the fiscal difficulties that we've been hearing from National Treasury. It does seem as though the midterm budget that's going to be delivered in November is going to be very daunting indeed. We already heard from Finance Minister Godongwana indicating that there's not enough revenue coming in, which I suppose is not a surprise given the fact that the local economy is not really firing on all cylinders. And the best prospect that we have of growth is somewhere around 1%. Some may even call it at sub 1%. But we're going to be discussing the potential impact of our fiscal situation on monetary policy after a short break. And so we continue our conversation with Mandisa Zavala, Acting Chief Economist at Alexander Forbes, and Mamello Matikinca-Ngwenya, FNB Chief Economist. Mamello, let's discuss the issue of the fiscal constraints that we have in South Africa. We've been hearing increasingly that the problems are quite bad. The budget deficit is likely to be wider than was anticipated in February. And if that's the case, it suggests that government may have to go out to the market to borrow even more money to plug that gap. In the meantime, National Treasury is pushing for cuts in expenditure, but of course you have those of the view that South Africa can't afford to cut expenditure because it's a developing economy and we need to be spending in order to, create growth and jobs, etc., etc. Given that, how do you think this intersects with monetary policy? Surely the two policies are supposed to support each other in order for the betterment of South Africans.
Absolutely. So I think that coordination between fiscal and monetary policy is quite important. And I think we have seen an example, although I guess the circumstances were quite extreme, of when there was coordination between fiscal policy and monetary policy. This was in 2020. But nonetheless, we find ourselves in 2023 and 3 years later, where I think this conversation around fiscal consolidation has been an ongoing one. In that I think you paint the picture quite well. That we have very high expenditure needs, but we don't have enough revenue to finance that expenditure. And ultimately, I think that the conversation around can we afford to cut back on spending, given where we are as a country. And I think, that conversation around trade-offs is quite important if we're going to talk about fiscal consolidation. Which are the areas that are inefficient? And where can we afford to slash expenditure? And I think that conversation needs to be had in a constructive manner because our reality is that we are an emerging economy. And if you cut expenditure in critical areas, you stand to compromise service delivery. You stand to get quite a bit wrong if that's not thought of properly. But the point here is our revenue is low and our growth is not delivering to the extent that we would need it. And ultimately, National Treasury will probably have to go out there to the market and seek a little bit of assistance. And ultimately, as your debt increases, it means that over time, you're going to spend more on servicing debt rather than actually channeling money back into areas of the economy that require that. So, and I think we've seen it now that, our debt service costs for every rand spent, we're spending close to 20 cents servicing debt. So meaning that 20 cents could have been actually, I guess, put back into the economy. And I think, when we think about, the central bank or the governor spoke about our long-term funding needs are going to increase. So in essence, as we go to the market and seek some of this money, it essentially means that we're going to be paying more of a risk premium. So the internal investors will require to be incentivized a bit more to take on South African debt. So they would look at that sovereign risk premium and look at monetary policy as well. So over time, then this just becomes quite problematic. So that, that's where the two meet. And I think, again, a constructive conversation around, what does efficient coordination between monetary policy and fiscal policy look like? Because the central bank, as it stands, is mandated to target price stability. And, the central bank speaks about that quite a bit, that their mandate is not growth. And National Treasury sometimes will also say, this is quite difficult to achieve because of where we find ourselves as an economy. So I think, constructive conversation, not only between the two entities, but I think between, government and politicians around how do we actually solve this issue is quite important, because I think if we leave it just to the two entities, we may probably not arrive at the point that we need to. I think this conversation probably goes beyond just National Treasury and the central bank.
All right, we're going to leave it there, ladies. Time is quite an expensive commodity. We've run out of it. I was joined in studio by Mandisa Zavala, Acting Chief Economist at Alexander Forbes, as well as Mamello Matikinca-Ngwenya. She's the Chief Economist at FNB, just unpacking the latest decision by the Reserve Bank to keep rates on hold. But the Governor, Lesetja Kganyago, saying the job of tackling inflation is not yet done, which I guess is a warning that more interest rates could still come.